All right, welcome to this week's episode of MVP Real Estate Podcast, Season 3, Episode 20, with Adam Gower. PhD. So what does Adam do?
Syndicate Investing, crowdfunding, investing.
Which is exciting for any investor out there that's looking to grow, because at some point, you're either going to hit your knowledge ceiling or your funding ceiling, where you bring in if that's you being a JV on a deal, which I'm sure Adam is going to get more into the weeds on that one. And syndicating is not something that we've done as a company. So I'm actually excited to learn a little bit from Adam and what he brings to the table.
He also talks about how to find or access discounted, distressed commercial real estate. So commercial real estate could be something else we lean into as well.
Yeah. I'm curious where commercial real estate goes. Obviously, with the dip in the market right now, and brick and mortar retailers are pulling out slowly. I'm curious to see what happens with that one. So we'll pick his brain with that one. But instead of doing a long intro, let's just bring Adam in. I like what you've got going on behind you. It feels like you are in deep thought.
It seems like I'm doing still. It seems like it gives the misimpression that I know what I'm doing.
What most of us are doing in this world.
Get rid of these. I really appreciate having me on the show today. Thank you so much. And I also appreciate the flexibility of letting me ask you some questions. I'm looking forward to it, especially with what it is that you're doing and what I know your audience is interested in. So my name is Adam Gower. I am founder of gowercrowd.com, and I also host a YouTube show at youtube.com/gowercrowd. And what we do, our main business is building marketing systems for large-scale real estate general partners. Right? So I'm going to use some really key terms, right? And I'll explain exactly what they mean. Because the same general partner the term can also be sponsor, operator, developers, a million terms. The legal term typically is general partner or managing member, et cetera, et cetera. But somebody who is out there as a professional real estate investor all the time, typically with a large team. Our clients have typically no fewer than $100 million of assets under management. And in total, they manage over 35 billion and have raised around $1 billion of equity using our system. So that's our core business. So they hire us to build marketing systems so they can raise equity capital from accredited investors. However, what that means is that I see through my work just about every asset class that there is. I will give you a quick background. You said 30 seconds. And the first thing you're going to realize, guys, is that I'm not very good at keeping things short.
That's all right. That's all right.
My background, and I'll try as best as I can to do it in 30 seconds. I started pulling wires for an electrician in 1982 in Southern California. Very quickly got involved in capital raising. I was in charge of investor relations for a ground-up multifamily developer in Southern California. Raised around 30 million in the 1980s, which in those days was a lot of money. It's not so much today. Then ended up in Japan. Short story. I'm trying to keep it short. Savings and loan crisis wiped out most real estate investors in the early 90s. I ended up in Japan as Daihyo Torishimari Yakushacho, which is Japanese for president of division of Universal Studios. And I was in charge of all their real estate development in Asia Pacific. When I came back, I started doing my own developments, and in 2007 sold out and went into the global financial crisis with no legacy problem. So I was brought into a major bank. And my job over there was to work on their non-performing loan portfolio, all collateralized by real estate. So I transacted a little over $1 billion while I was there, all individual loans that were collateralized by commercial real estate. In those days, I've never really touched single family home because it's a whole different, on the distress side, it's a whole different thing, foreclosing on families. And so I've never touched that. Then I ended up at Colony Capital working on a $7 billion portfolio of non-performing loans that they had bought with the FDIC from failed banks. Oh my goodness, it was fascinating. So these days, as I said, I've kind of evolved into becoming an expert at raising capital. And so we build marketing systems, digital marketing systems for large scale sponsors slash operators slash general partners who want to raise money from accredited investors. That is more than 30 seconds. I managed to spend about 10 minutes.
You could never do that background in 30 seconds. So I'm impressed with how quick you got that in.
Well, you got to listen to it at
awesome
2x speed.
background.
That's the only way. Yeah. Right. Now let's talk about single family homes. Can we do that?
Absolutely.
All right. So what's going on where you are? I want to hear what's going on. I'm in California. So, and I've got my finger on the pulse of what's going on in single family. And you've talked about wanting to get into multifamily. So you're going to have to ask me some questions about that. But before you do, what's going on with the single family home market around where you are?
It is as close to a freeze as I've ever seen it. People aren't wanting to sell. I mean, everybody wants to buy, but do you qualify for a loan? That's a huge question mark with the interest rates being so high. Prices are still through the roof.
Why do you think that is? As interest rates have gone up, what are you seeing? Obviously, I have an opinion. You can tell I'm not the kind of person that doesn't have one. But what are you seeing? Why do you think people are not selling if prices are still high?
Fear of the unknown. I think they're fearing of the looming of what could be coming, and they're not trying to move. Some of them are locked into really low interest rates and don't want to assume a new interest rate that's going to be almost double, maybe triple what they're in. So I think there's some hesitation of the future, and they're in good rates right now, so they're trying to keep it going.
And what do you mean for a fear of the unknown?
Well, with the market heading where it's been heading, I don't know if they think a crash is looming, which it could be, and they don't want to be stuck without their asset. They could be on a 3% mortgage for the past however many years, and they've got all this equity built up. And they basically have the decision of, do we sell our house and get our cash and get that equity out, or do we keep our home and try to weather the storm of what crash could be coming? I think that's a big thing here in the Midwest.
But I also think that that's related to non-investors. I think it's like you're talking more with like families. The investors are still out there trying to buy, and that's why prices, I think, are still as high as they are. The market is as competitive as it is.
On the investor side, I feel like there's a lot of people that will sell. Prices are inflated, and I feel like they will buy. The bigger investors are willing to pay that price as a hold cost. So it's kind of cutting out the actual first-time home buyers or the people that are buying and would live in it.
So wait a second. So you've talked about a freeze, and this actually is what I'm seeing here. So just kind of drill down on what you're saying. So you've talked about a freeze. So prices are holding steady?
Yes.
But are they continuing to rise at significant amounts in the same way as they have been for the last few years?
No. I mean, they rose obviously the COVID years, and they just haven't dropped since then.
They've not dropped. Right.
Yeah, they haven't dropped much. I mean, maybe you'll get some houses at asking price, which is crazy that's like a secondary option. Because we were just looking at houses yesterday, doing some analysis on some future prospects, and homes are going 30 grand over asking price, selling within 30 days. So it was quick. Prices were elevated, but right now they've stayed pretty consistent. Yeah. The one thing that's changed is the inventory is very low.
Right.
So that'll help keep the prices of the homes up. I just had a listing here. Basically, if you wanted a house in that size, you have one house to choose from, and that's it. That's how much inventory is on the market.
Yeah. Right. So prices are holding steady. They're not going up, but they're also not coming down.
Yeah.
Right. So now you use the term investors. to mean I'm going to ask that means fix and flippers, somebody that wants to improve a property and then sell it within a short period of time. Is that correct? They have no intention of living in it.
Yes, those are investors. I mean, you can also do the buy and hold, which is kind of what I like to do, is the buy and hold investing.
Right. And do you think where do you think pricing for homes is going to go?
I want a crystal ball. Can you tell me?
Well, I
have a theory. I have a theory that
theory?
things are going to crash and go downward.
Yeah.
Something's got to give. Home prices has to go down. Interest rates have to go down. There needs to be some movement, because right now it's just at a deadlock.
Yeah. Okay. So it begs the question. So I had a conversation with a fellow called Charlie Nathanson. He's actually a professor at Northwestern University, or Northwestern. And
Chicago, that's the Midwest area.
This was a few years ago. And what Professor Nathanson had done was he conducted a study on home prices and what drives home prices. And what he discovered was that as prices move towards their peak for home prices, right, on a per square foot basis, the number of people engaged in the market, or the proportion of people who are fix and flippers, what you call investors, increases dramatically. They start to become the primary buyer of properties, and you can tell this by looking at how long people hold on to the homes. So it's the investors that start to dominate the market as pricing goes up.
Mm-hmm.
As soon as investors come out of the market, volumes, the first indication is volumes drop off a cliff, but prices continue to go up. I'm trying to draw this with my finger. I'm like, if you're watching or listening,
I got the visual.
But prices continue to go up. And then it's like Wile E. Coyote, this idea of Wile E. Coyote running at high speed and then suddenly dipping his toe beneath himself and realizing there's nothing beneath him, and he falls. Mm-hmm. So that's what happens to pricing. The first thing that happens is that investors come out of the market. You see volume drop off, prices continue for a while, and they plummet then alongside volume. So that's exactly where we are, which means we are at peak pricing today, absolute peak pricing, which begs the question, how would an investor possibly justify buying a home today if you have to make the assumption, in order to make money, that prices are going to continue going up? Mm-hmm. You cannot be an investor in this market unless your underlying thesis is prices are going to go up. I'm going to buy it today, and prices are going to be higher in a year's time. If you cannot make that assumption, nothing will make sense today. And as soon as investors come out of the market, suddenly the only people left in the market, people that want to actually buy homes and live in them. Mm-hmm. And now you've got a 7% interest rate instead of 3%. The first thing that you said, Marcus, was, now people don't even qualify. So now that demand side of the equation has gone smaller. So it is inevitable that you're going to start seeing prices come down.
Yeah.
And I think that is exactly what's happening in the market today. There's another component of particularly the single family home market that we've not talked about yet. What is the market for? By the way, I just want to put something into perspective. Just FYI, 30 days, it's a fast deal, 30,000 over asking, and 30 days, it only takes 30 days to sell. What is the typical strike price like for a 3-bedroom home?
I think our median sale price, the last time I looked, was around the 360 range 360. In Wisconsin.
Okay.
Yeah. Now we have to equate California price to Wisconsin.
Right, I was going to say 360 is not enough of a down payment in California. You need
that's a shed in California. Payment.
I don't know if you can find anything for 360. You can find mobile homes for 360.
Yeah.
Seriously. I mean, 250 to 400 that's double wide.
Yeah, but
Somewhat basic.
I think, and Dan, if you can verify that, but I think the last number I read from the WRA here in Wisconsin was the median home sale price was 360. And I always wondered, because obviously we do have the homes that are higher priced, but I'm wondering with the interest rates going up, how that affected the buyers and what they could afford. Because pre 8% interest rates, you could afford a home of 400,000. But now that they're double what they were expecting, that lowers your buying power, and now they're buying at 300. And there's only so many $300,000 homes out there that are actually on the market.
Well, that's exactly right. And so actually, I don't know if you saw this piece by Mohammed L Arian, who's also, I keep talking about professors and everything. I don't mean to sound too academic or cerebral, but he's quite a famous economist. He's out of Oxford University in England. And he used the exact same term that you did, was that what the Fed has done is actually frozen the housing market. Because now you've got people who are locked into sub-3 interest rate mortgages. And even if you want to downsize, let's say you suddenly you're an older couple, you find yourself overhoused, you're a 3-4 bedroom home, your kids have moved on, and you want to downsize and move into something that's more economical and is smaller, etc. What you're finding is, there's one demographic. What you're finding is, why would you sell something, basically get out of a sub 3% mortgage in order to buy a 7+ mortgage? You're going to buy something small, it's going to cost you more. Yep. So it's frozen the supply side because people that can't afford to sell. Forget the equity. Where are you going to live, right? You're going to buy something higher. And it's also frozen out buyers for exactly, again, the reasons that you've said, qualification, and that they can't afford as much anyway. First, they qualify for much lower mortgages. So it's frozen both sides of the market. Now, there's another side of the single-family home market I'd be interested in hearing from you about. What is the Airbnb market like in your areas? Are there a lot of homes that were purchased for rent?
There's a lot of municipalities that are trying to shut it down. In my area specifically, we're called Lake Country. So people from Chicago, from the north will come down, and they kind of congregate here in the summer. And the municipalities around here put the kibosh on Airbnbs because of noise complaints. And
how long ago? Is that happening now, or is that something
that's been since it became popular? They kind of turned that off and said because people would rent out their lake homes in the summer, and then there was noise complaints, and they didn't know the ordinance with lights, and it just caused a lot of problems. So do people do it? I'm sure. But if the city catches on, you get a pretty hefty fine, and that gets shut down pretty quickly. But there is some in Milwaukee. There's some out in Madison. So other counties will allow it. But it's not as big as the vacation spots, the Californias, the Floridas, the Texas. Yeah.
So that's also a factor, that some of the Airbnb homes that are not performing as expected, or that were, some of those are coming onto the market. That's adding a little bit to supply, but not very much. Yeah. All right. So what else do you want to know about me?
I wanted to get into syndications because I feel like every investor, whether you're new or been in it for a few years, you're going to hit a road where you're going to start doing some syndicated deals, either with another investor, or you're going to have to raise some capital or be a JV on a deal. And it seems like you've got a wealth of knowledge in that field. So I kind of wanted to go on that. Is that an area that you want to go into?
What would you like to know?
I want to start with, specifically for us, we've never done any syndication. We've always had our own self-funding. We look into like subject to and owner financing kind of things, but we've had a couple of guests on the podcast as well that talk about JV deals and syndicating. Where would you give someone like me and Dan, I guess, advice into where to look if you're a new investor and you're trying to get into the syndication game?
How do you mean where to look?
So
as an example, like maybe I'm a little high, but say we had $1 million and we wanted to invest in commercial property, or like whether that's apartment units or commercial, like a retail. Where would we go about trying to place that money? And I think right now we are trying to stay within our home areas, but I think that's also limiting us. So I think that's taking away from certain opportunities. We have talked, like Marcus said, to other people on our podcast, and then we've had conversations outside the podcast related to, what do we have to do to be accredited? What does that look like? Do you need to have, obviously the financials for us to know that we are legitimate opportunity to invest or place the capital? But where
are we thinking about that correctly, or should
right?
we
Okay,
clear
good. So now I understand
mindset?
what you're asking. Okay. So let me help you.
Yeah.
Yes.
Okay. So first of all, that is the only way to become accredited. There's a few ways to do it, but the primary way of becoming accredited, and the Accredited Investor standard, which was set by the SEC in 1980, actually, or 1982, very early 80s, is nothing more than basically a wealth and income hurdle. So to be you either are accredited or you are not accredited. And the way to be accredited, you need to have had at least $200,000 of income for the last 2 years, and a reasonable chance of making $200,000 this year, or $300,000 if you are married and filing jointly.
Okay.
Right? Or $1 million of net worth, not including your primary residence. So that's kind of the floor or the basic definition of being an accredited investor. Now, there are some ways of some qualifications and some other ways that you can become accredited, through study. But those are not going to be avenues you want to pursue. So they are basically wealth and income hurdles that you have to cover. Secondly, the next question is, let's do it this way. So that's the accreditation. You also Dan talked about how to, if we had $1 million, what kind of deal would we look at? Well, here's the thing. You cannot put the money ahead of the deal. Mm-hmm. What you need to do is to find opportunities that you consider to be worthy of investment, and then go out and find the money. So what you might do is start by, you need a thesis. You need to have an investment thesis. Like, what are we going to be investing in? What are our strengths? What are our weaknesses? If single family home flipping is your strength, you should probably stick with it. If you like the idea of scaling up, you can either scale up a single family home portfolio, or you could start looking at multifamily. As soon as you do that, though, you are stepping into a very different world.
Yes.
And my advice to you would be to go on some of the crowdfunding websites, or to find a multifamily sponsor somewhere. And this is, some of our clients do this, and there are plenty of them out there. Do not be seduced by the get rich quick kind of fee. If you see anything that gives you the feeling that this is a quick way to getting where you want to go, run in the opposite direction. That's the quickest. That if you want to see a quick solution, run quickly the other way, because they will send you down the path of failure.
Yeah.
So
we're going to highlight that part. Highlight that one.
Yes, exactly. So then what you want to do is, you want to find people who are really pragmatic, those whose story you might not really want to listen to. And it's going to be the story that says real estate is a long-term game. Our returns are, and you might need to read between the lines, lower than you see elsewhere. But we are set up to survive downturns. All right. So those are the kind of sponsors you want to be looking at. And then see how they do it. Get on their webinars, Q&A them, ask them you can ask them all kinds of questions, right? About what they're doing and how they're doing it. Get into I mean, they will produce and present to you as a prospective investor a lot of information about how they've done the market study, how they've analyzed rents in the area, and you can kind of use them as case studies to learn how to underwrite a project, a multifamily project. So that would be a good way to educate yourself on what's involved. Then when you do find a deal that you want to work on, then what you also want to be doing. So now you've got a thesis. Here's what we're going to be doing. We're going to be looking at and pick a number. Dan, you said, if you were fantasizing $1 million, all right? So that's fine. So let's say that is what you're looking at. So you're looking at $1 million of equity. That would mean you could call it a $3 million property, right? So that's in Wisconsin with a $300,000 average, $360 average purchase price for a home. That's a decent sized multifamily, I would imagine. I don't know what you can buy for $3 million, but you now start communicating with your network, and you can do a newsletter, or you can do it on your podcast, or even just create I mean, you guys are used to recording stuff, so get on a Zoom call, record yourselves explaining, this is how we're figuring this out, this is what we're doing, and this is how we're doing market study, and this is how we do a rent study, and this is what we're looking for. And then you signal to your network of prospective investors that you are looking for multifamily properties between $3 and $5 million in size, and this is what it's going to look like, and these are the criteria that we're looking for. And you can add layers to that. You do your research first, but you'd add layers to that. You can say, we want to see, density, population density, I don't know, population density, employment within certain number of minutes, certain age of property. And we want to be seeing average rents at a certain level below market. We want to be able to see comps of a certain type, right, that justify increasing rents, et cetera, et cetera. And then you've also got to have a plan in place how you're going to be upgrading the unit. So start doing your research, figure out, what does it cost? Here's a great thing you should do, actually. This is what I do whenever I start looking at a new market. You want to be talking to other experts in the area and learning from them. But nobody is going to take your call if you just say, hey, listen, can I pick your brain? Nobody wants to do that. Yeah. Why? Because everyone's busy. You want to talk to general contractors. What does it cost to renovate a unit? Yeah, they'll give you 5 minutes. They'll give you one number, they'll be off. They're not interested. Yeah. So the best thing that you could possibly do is to find a deal, even if it's one you're never going to buy. Don't tell anybody except everyone listening on this, YouTube and the NSA, whoever else is tuned into what we're talking about. Find a deal that you have absolutely no chance of buying. It doesn't really matter. Put it into escrow. Well, or you don't want to do that, because then you burn your reputation with brokers. But get it teed up, start talking to the broker, and then call general contractors, plumbers, electricians, I don't know what other trades you need there over there, right? But your main trades. Yep. Maybe call an architect or a designer of some sort. Go and look at all the properties in the neighborhood and see which are getting the best rents, and go and do a rent survey. Okay, how have they upgraded their unit? They'll tell you, right? The property manager will tell you, we upgraded this unit and the rent is however much it is now. And you can ask them, what was it before, right? How much you're getting in the other units? And they'll tell you. And then ask all of those trades, tell them, we're looking at this property here at the corner of Walk and Crosswalk. Will you meet me over there and give me an idea of what is involved upgrading the plumbing? or upgrading the electrical, or doing the countertops, or switching out all the flooring, and get numbers and start plugging those real numbers in. Now, what's also going to happen is they will give you real numbers that you can actually take to the bank, as it were, and start plugging those numbers into your pro forma. You got to build a spreadsheet. And then as you start seeing deals, suddenly one of those deals that you look at, you're going to have to look at 100 deals before you find one that works. One of them suddenly will make sense. You'll have all the numbers. You'll know exactly what the numbers are. One of them will make sense. And if you do this, if you communicate with your network of prospective investors along the way, and you share with them your story of how you do this, they will be ready to invest with you when you find the right deal, because you will have taught them how you're identifying a good opportunity as you learn it. And then they'll know, yes, I agree. I know exactly what he's looking for. He's found one that works. All right, I'm in.
Yeah.
That's what I would do.
That's good. And I like how you pointed out the obvious. It's going to be very hard to get a call back from people if you just pick up the phone call and say, I want to have lunch, or meet up for coffee and all that stuff.
No one wants to do that.
It's difficult. And that's why, I know in the earlier shows I talked, if you have the ability to work for somebody for free and bring them value, it'll go miles for you.
Well, yeah, and the point I'm making is you don't want to work for somebody for free.
Well, right. Just bring them value. Bring them something of value.
And they will also, and then the other thing is that when you get the plumber over there, you can say to them, hey, listen, do you know any good electricians, or the foundation guy, or a roofer? Who can you recommend? Then you call the roofer and you say, look, so-and-so suggested. And then you can ask them, have you worked on any upgrades on other apartments around the neighborhood? Yes. Well, what did you do? What else did they do? Who can I talk to? Do you know who the designer was? Go to the local building and I don't know what it's called, but the local building and safety department. Most permits and any kind of work done on any property in most jurisdictions across the country is publicly available. Public information. So you go to the you go down to the local building and safety counter, and if there's an apartment building that's been upgraded recently, say, can I have the file on this apartment building? Yeah. Pull it out and see who the designer was, see who the plumber was, see who the electrician was. Give them a call, but don't say, can I have lunch? Say, I'm looking at this deal at the corner of Walk and Crosswalk. Will you meet me over there? Yeah. I want to walk around. I want to get a bid from you. We're trying to put an offer in. Okay, now they'll come over. You don't want to waste their time on this deal and the next deal and the next. The first time you do it, you're going to get all the information you need about pricing. Oh, and you can also ask them, what are trends at pricing going up? Also, don't forget with your subs, what's your lead time? Because it's no good if your contractors are saying, yeah, we can do this for, less than anybody else, but we can't get out here for 6 months. Yeah. You don't want to do that. You want to be sure that they're available. So you might not be doing a low bid deal. You might be doing a middle bid or even a high bid deal. It doesn't matter. If you can get people out there and turn a unit quickly, underwrite the difference in your spreadsheet as you try and figure out if a deal's going to work. Yeah.
Interesting.
I mean, people are probably going to have to rewind that one. I'm going to have to rewind that one to recap all of the steps and things we should do. But there were a couple things that caught me, and I wanted to ask you questions on them. Yep. One, you were saying, obviously, don't put the money before the deal. And you are the man that's in commercial real estate. And before the show, me and Dan were talking about how brick and mortar stores are pulling out and going backwards. Office space is retreating. Where do you see, just personally with you, and that could be within like the California market, where are those opportunities in the commercial space for you and that what you're looking at without giving away your secret sauce?
Oh, no, I don't mind sharing all my secrets. It's totally fine. I'm an open book. Right. So opportunities are, so in the commercial space, this is what's happening in commercial, it's particularly in multifamily. Well, not particularly. Across all asset classes, multifamily has got this reputation for being recession resilient. It really isn't. If you get it wrong, you're going to lose your deal. Mm-hmm. So this is what's happening. A lot of larger scale multifamily deals, apartment buildings across the country over the last 3 years or so were financed using increasingly, that's the one word, we're financed using decreasing standards of qualification. In other words, it became easier and easier and easier for sponsors or for investors to get debt, to borrow, to buy bigger and bigger deals. So it became easier for them to do that. The standards that the lenders were imposing were getting laxer and laxer. And so what that did was it enabled people to make deals pencil at much higher prices than actually their true worth was. So what that means is they overpaid.
Yeah.
They overpaid. And the assumptions that they built into their underwriting, which is exactly what I've been telling you how to do, the assumptions that they built in that included rent growth assumptions over the next few years, insurance rate assumptions over the next few years. That's another line item you absolutely need to bottom out. Make sure you know how much insurance is and assume that it's going to go up. How much are taxes on the property? How much are interest rates? All of these assumptions that were built into these overpriced acquisitions over the last few years have proven wrong. So now what's happened is that a lot of and I will tell you, this is probably up to 90% of all multifamily deals purchased in the last 3 years now have cash flow problems. The amount of cash coming off rental, net operating income, basically driven by rents, is not enough to cover the amount of debt on those properties. And so all this stuff behind you that you see here on the whiteboard, this is what's happening. This is what I call the real estate syndication vortex. This is where both sponsors, general partners, and their investors, their limited partner investors, are getting sucked into situations they would rather not be in, where they need more capital than they had expected when they did the deal in order to not lose the deal to foreclosure. So what does that mean for guys like you? Well, what that means for guys like you is that a lot of properties are going to be coming back on the market at extremely distressed levels. So the pricing, just like we started talking about, anticipating housing to crash, pricing for multifamily, for apartment buildings, is also going to come down very, very significantly. I think Morgan Stanley was projecting 30% or so. I forget exactly how much, but that doesn't seem unrealistic. Significant declines in values, meaning opportunities for you.
Yes. Did Morgan Stanley put out a timeline on that one? Like a projected what they thought?
Yeah, I just put it out in my newsletter. I think projecting over during this downturn, but within the next year. Most of their defaults are they're starting to kick in now. But
I think it's going to be like Q2 of next year.
The big wave is going to start in the beginning of next year, because most of the bridge lending that was done started in the beginning of 2021. So once that kicked in, they're now on 2 or 3 year terms, or their rate caps are starting to expire. So that's what you're seeing is going to start hitting the market. And then as soon as those deals come to market at depressed prices and values, either through foreclosures or forced sales, or for whatever reason, those values now start to reset comparable values. So comps start to reset. And as comps start to reset, we start to move more rapidly towards bottom.
Yeah. Which is a scary thing. And I think people are I think there's going to be a lot of panic around it. I think people within real estate understand it's coming. I think other people are going to kind of panic because we've just been on this peak, and now we're going to go to the valley, and it's not going to be pretty.
No, that's right. But it always happens. So
it's always cyclical, which is very cool.
So, guys, so unfortunately, I've got a bit of a hard stop coming up.
That's all right.
I can't believe how long we've been talking. It's gone by so quickly. It's really a pleasure talking to you. But
Yeah.
so if you don't mind, do you mind if I pitch something briefly?
I was just going to say, if we're going to cut it off, please tell us how
Yeah.
people can get a hold of you.
All
And
right.
if you've got some literature, I'm sure.
I do. So so this whole rocket science thing behind you is actually a presentation that I made to an exclusive group of investors. And nobody's seen that presentation except for them yet. So what I've done is I've actually written a book. I think I'm going to call it Capital Calls and Rescue Capital.
Okay.
It's going to come out hopefully by the end of next week. I'm just wrapping it up now. It comes with some free training, which is this whole presentation here, and a bunch of other stuff. It's really cool. It's only a $7 book. And if you don't like it, let me know and I'll send you your money back. All right. So it's like satisfaction guarantee. And you'll be able to access it and me at gowercrowd.com. So that's my last name, Gower, gowercrowd.com. And subscribe. I have a newsletter. It goes out every Wednesday. It's free. You can always unsubscribe, but we cover all these topics that we've been talking about today and updates on what's going on in the industry. So that's gowercrowd.com.
I'm subscribing right now. So
all right. Well, you got 2 subscribers because I'm going to subscribe after the show.
All right,
you're going to get 3 book purchases because I'll buy one for me, Dan, and then our other owner, Val.
All right.
So we'll get those as soon as that gets out as well.
Yeah.
Because I would be happy and very happy to read all of your literature that you've got going out on that newsletter, because I know you're a wealth of knowledge just from the 45 minutes that we spent on this call. So
thank you.
I appreciate the time you gave us to share that. We'll make sure to put all of your contact information into the show notes.
Lovely.
Hold on. I feel like we're cutting you off. Was there something else you wanted to get to? Because I know you got to the newsletter part, but
no, thank you. That's really good. It's really gracious of you. But no, we're good. I think just sign up for the newsletter. I mean, that's really we send something out every Wednesday. There's usually some educational stuff in there. There's 1 million words of content on the website. There's a little search bar, so you can search keywords, and there's a lot of stuff. 95% of what I put out is there's no cost to it. There's just some premium stuff that it costs a little bit, not much, like a book for $7.
Mm-hmm.
But most of it.
I'm looking forward to that book. That'd be great. And then also we'll tie in your YouTube channel to the show notes as well, so people can click on that and go to there.
All right, cool. Thank you so much.
Thank you very much for your time. I appreciate it. Enjoy the warm weather out in California. We're starting to get cold over here.
It's a real pleasure meeting you. Thanks so much for
hosting
me today.